Hi there, everyone. Well, really good to see you today, or to be able to present to you today. Hopefully, we've got a good and interesting presentation for you for the next hour or so. Thank you very much indeed for taking the time out. For those who haven't seen me present before, I'm Dave Lowery, the Head of Research Insights here at Preqin. The aim for the presentation today is to provide you a bit of a global context with exactly what's going on in the alternatives market, and then we'll drill down into a little bit more detail on the real estate market, talking about exactly what's happened thus far in 2021, and hopefully looking a little bit further throughout the back half of the year into how the market might be evolving into 2022. I'm sure there'll be some interesting points anyway. We're hoping to have a few questions as well, so if you can, I would encourage you to submit those via the Q&A box, either during the presentation or at the end of the presentation. We'll get to as many of those as possible. We have an hour for this session and a fair bit to cover, so I shall crack on at a little bit of pace. But if there's anything, any questions you have, please do send them through. So firstly, for those of you who aren't too familiar with Preqin, we are the leading provider of alternative assets data with global coverage across fundraising, performance, deals, and LP and GP activity. We've got several hundred research professionals working around the world who collect and collate our data on the industry. And all of the data you see here today is a combination of their collective efforts and Preqin's global reach. So firstly, excuse me, and just to provide a bit of overall context as to where we see the market as a whole at the moment, I'll go through a little bit more detail on our alternatives AUM growth forecast, which we actually updated relatively recently. You may have seen our Future Alternatives campaign, which launched toward the back end of last year, but we've updated these numbers now because we were very, very conservative when we put these numbers together initially, and they were based on Q2 assets under management data from last year. And obviously at that point, markets were pretty much on their knees almost across the board, and nobody was really sure exactly how markets would evolve throughout the rest of last year. So what we can see here is solid growth across all asset classes over the next 5 years or so, with AUM growth set to accelerate from the levels experienced between 2010 and 2020. We are relatively bullish now compared to where we were last time, and expecting 17% growth per year overall. And it'd be fair to say that AUM growth in recent years particularly has been driven by both strong fundraising markets as well as solid performance. You can say that 2020 was actually no exception, and that was the 4th consecutive year with private capital fundraising of over $1 trillion. When we look at what's driving allocations to alternatives and the growth in the alternatives AUM altogether, we still see a huge increase in allocations to alternative markets. And managers are really kind of reaffirming their relationships with clients. They've proven that they can operate in very tough environments. We're seeing investors a little bit more worried now about the potential for rising inflation. We're seeing a few more concerns about public equity valuations. And again, a little bit of worry what might go on in fixed income markets, particularly if we start to see a more aggressive or unaggressive tapering by the Fed. So there's lots of uncertainty out there, and investors are really keen to kind of park their capital for the long term in the knowledge that alternative investments generally have delivered solid returns throughout the market cycle in previous years. I'd say that's really one of the key strengths of the industry as well at this stage. Managers throughout the pandemic have proven their ability and willingness to work with their portfolio companies to either drive returns or to try and guide them through what's been a very difficult, often just a short-term cash flow issue. Certainly doesn't make it an easy market, but the managers have been really good and open with their communication to their investors as well, and I think that's really cemented these relationships. What we would say though is that although growth looks like it will be strong, it's not going to be consistent either across asset classes or geographies. To us, private equity stands out as set to deliver the strongest growth, followed by private debt and infrastructure. Within the regions, Asia is likely to see the strongest growth of any region, and investors are telling us in our surveys that they do intend to allocate increasing amounts of capital to APAC investments. There are often questions around whether rising amounts of capital can be deployed and whether it's actually easily absorbed. And while there was some hit to deal activity last year, it wasn't consistent across all asset classes or geographies. And we'll come a bit more onto our deal data, particularly as it relates to real estate a little bit later on. If we look now at this regional breakdown, you can really see here that the US is still going to remain the dominant region, so there's no change on that front. But the rise of APAC, which is the blue bar in the stacked bars that you see in front of you, really does stand out. What we can see here is the absolute growth, either on an asset class basis in the chart on the left, or on a regional basis in the chart on the right. So we can see that private equity is likely to remain the fastest growing, followed by infrastructure and private debt, as we've just said. But the scale of Asia's growth is what really stands out here. So we put the axes on both charts up to 300%. We're going to make them consistent, so you can really see the relative growth in APAC particularly. One interesting point to note here is also the growth in the diversified multi-regional AUM, and this actually points towards funds without a single region as a primary area of focus. It also points towards a much more flexible approach to deployment. So these funds will often kind of go and scour the globe for the best deals, regardless of where they're located. And I think investors are actually kind of willing to give managers much more flexibility with regards to this in the hunt for returns. So when we turn now to the fundraising picture and the fundraising outlook, excuse me, well, we can look at what's driving fundraising. Is it solid performance, influenced by the rising allocations to alternatives? And I'd say it's probably both of these things. And if you look at where we are now compared to where we were last year, as of 9th of June, when these figures were updated, we're almost 54% of 2020's funds close have been raised already. And so we're almost kind of, a month to 6 weeks ahead of where we were at this point last year. Interestingly, on this chart as well, you can see that the number of funds closing peaked in 2017, and this is primarily on the back of a big increase in APAC-based and APAC-focused funds between 2015 and 2017. There was a real influx and a real increase in the number of PE and venture capital funds, particularly targeting China within this time. But then post-2017, a government clamped down on foreign exchange and capital controls, plus the deteriorating relationship with the US served to really slow that part of the market down. So while we've seen a decline in the number of funds closed on an aggregate basis since 2017, the amount of fundraising has actually been increasing and was actually maintained at pretty solid levels throughout 2020. So we've had 4 years of $1 trillion plus, and you would certainly kind of bet for a fifth year of another $1 trillion plus as well. I think we're well on track to go and hit that, and probably potentially far exceed where we were last year, which I think is a pretty incredible performance, really. In terms of threats to the outlook and to our forecasts, well, what I would say, this is our, I suppose, a base case scenario. There are certain circumstances where you could see, excuse me, some potential upside to those numbers, and there are also some circumstances where you can see some potential downside. Inflation is the topic on everybody's lips at the moment. It's generating lots of column inches, and it does remain to be seen exactly what will happen with inflation. Everybody's expecting, well, everybody, a large proportion of people are expecting inflation to be quite transitory in nature and not become too embedded. Whether that will be the case or not still remains to be seen, but certainly the Fed are probably kind of furthest along in their inflation journey, and their communications, both by the FOMC minutes and the Powell's testimony as well, are being watched like a hawk at the moment, just for any tips as to exactly what might happen and how that market might evolve. What we would say though is that inflation right now is probably at the upper range of what we would kind of deem as comfortable. If there's a prolonged period of relatively higher inflation, and if that brings forward any potential Fed rate hikes, then that's something we'll be watching relatively closely, well, very closely. We get lots of questions around inflation and market outlook, but I think at the moment we're not as worried as we potentially could be. So that gives you the global context with where we are at the moment, gives you our AUM forecast, and I think that kind of paints a relatively positive picture of the alternatives market as a whole at the moment. You can certainly see why the likes of Morgan Stanley have been putting out some relatively aggressive AUM growth forecasts of their own. And you can see why the likes of JP Morgan is setting up individual private markets and alternatives business units within their organizations. It is a part of the market that is attracting a lot of interest at the moment. But as we say, not all of this is evenly spread. And I suppose right now, one of the parts of the market that maybe isn't performing as strong as some others is real estate. But having said that, despite the relatively weak pockets within real estate at the moment, we are still relatively positive on real estate AUM growth over the next 5 years or so. So between 2015 and 2020, we saw growth of just over 7% per year. We're actually expecting that to increase to 10% over the next 5 years or so. What you can see here is that we are actually behind the growth that was experienced in the years post the financial crisis, so 2010 to 2015, when growth was 12.5%. I think what this points towards is that it's getting more difficult to deliver this growth as the cycle was evolving. We are still behind the post-GFC trend, and one of the reasons for the strong performance there is that there was a big repricing across all real estate sectors post the financial crisis. It was the nature of the beast. It was a financial crisis. So we saw declines in values of up to 60%, sometimes even more for individual real estate assets throughout that period. We certainly haven't seen that wholesale level of repricing in the wake of the pandemic. It's been really concentrated on certain areas of the market. So you can definitely see retail has been quite heavily impacted by the pandemic, as well as the hotel sector as well. But the retail sector particularly was struggling before the pandemic. So I think what happened there was that the effects of lockdowns and the effects of the pandemic there were kind of more exacerbating issues that were already prevalent. The rise of online trading and the move from retail asset owners to position their centres as destinations where people could go and enjoy going to the movies. They can go for a meal, they can kind of spend much longer in these centres, and then they can potentially just really kind of benefit from that longer dwell time and increased average spend across the board. What I would say here as well is that you can really see that probably, although we've straight lined our forecast out to 2025 here in these numbers, that we could potentially see a bit of a weaker 2021 and 2022 and an acceleration in growth towards the outer years of this forecast horizon. We can also see the pandemic effects and also the late cycle effects kick in on the real estate fundraising markets here. So we've actually seen the pandemic effects linger into Q2, and we're so far this year, 2021 is looking like it could see a bit of a continuation of that weaker fundraising market that we saw last year. Half one is looking quite weak, and we'll come on to a bit more of a detailed look at the quarterly numbers in the next slide. But I think if we can put the fundraising environment into context, the number of funds closed every quarter between Q1 2016 and Q1 2021 was 121. So far in Q2 of this year, this is data up to the beginning of June, we've seen 39 closed, so we're only 32% of that longer term average. Uncertainty is certainly at the front of mind for many real estate investors and managers. The emergence of some of these new variants of COVID-19 virus are actually adding pressure to office occupancy, particularly in markets where just a few weeks ago that there was a more positive outlook. And I think we can kind of point to one example there, which is Singapore. So office vacancy for category 1 offices, which is those that are located in core business areas in downtown or the Orchard area, and they're generally relatively modern or recently refurbished, it's continuing to increase. So vacancy's gone up from 7.2% in Q1 of last year to 9.8% at the end of Q1 2021. And we've got to remember that that's actually a relatively strong performing office market as well, up until the last month or so, when work from home messages were put out by the government. So I think if we're seeing that level of uncertainty in office markets in a relatively strong region or strong city area, then I think investors are definitely going to be thinking twice about whether to commit to that part of the market. And we're definitely seeing that in the numbers at the moment. It still does remain to be seen, particularly for offices, what the future level of demand will look like as and when we do start returning to the office. We've seen things and comments in the press recently about some organisations saying you must have both vaccinations in order to return to the office. We've certainly seen others on a global basis saying that they are allowing their employees to work from wherever they like. Some will be in the office, and I'd imagine a large proportion will continue to work from home. And I think this is how employers over the next year or two can actually then start to differentiate and try and attract talent. Will there be a rush for people either switching jobs or entering the office market to favour those where they're allowed to work from home? I think that's still a big question that needs answering, and we won't get any real clarity on that until office markets open back up and we start to see exactly how demand is panning out. Offices certainly there will have to be managed from a peak demand perspective rather than average demand. So if you're allowing people to work from home 2 days a week, but then everybody is in on a Wednesday, Thursday and Friday looking for potentially to some after work drinks, then you've still got to plan your office space on everybody being in at the same time. So it means that managing your office space as an employer will actually become much more time consuming, I would imagine. And I think that there's a lot that the real estate asset owners can do to aid their tenants in that management of their space, and particularly when it comes to configurability. So looking at the quarterly picture here, I would certainly hope that Q2 will be a bit of a nadir for real estate fundraising. We've only had 39 funds closed in Q2 up to the point that this data was pulled, raising an aggregate 13.5 billion. So these figures are actually the weakest in at least the last 5 years. So the data doesn't improve significantly when we are looking at the capital raise picture as well, which is kind of why I'm saying that many investors are willing to sit on the sidelines. They're kind of willing to see exactly how the market pans out before they do start to commit capital. But having said that, the bulk of the capital being raised in global real estate markets is continuing to target the market arguably furthest along in its recovery, so North America. So this is the dominant region, and it has been and is likely to continue to be so. It accounted for 56% of the funds closed so far in Q2 and 75% of all capital raised. So this points to North American funds being larger than average, in stark contrast to those who are particularly focusing on Europe, where the average fund size has been falling over the last quarter. Investors are quite wary still of committing capital to Europe. I think that could potentially be because Europe's a bit further behind in its recovery phase. Many lockdowns are still in existence, and they're still being quite rigorously policed as well in those markets. But it could just be allocators as well, being less willing to take big bets with a particular manager or on a particular strategy or targeting a particular region. If they're handing out smaller sums to managers and favouring potentially smaller funds in general, it does beg the question as to what does that mean for the big mega funds? Is it going to be meaning that they spend longer in market to attract the capital they need if the average investor is committing less to real estate? So again, that's something that we'll be looking at from the data as we progress through this year. It's certainly one of those things where we look towards the rest of this year. It's still been relatively tough in the first half of 2021 to date. Personally, based on my own 20 odd years of looking at real estate markets, I would say that I'm a bit more positive on the second half of this year. I do feel that investors will start to really position themselves ahead of the recovery curve and try to commit to managers who they feel are best placed to, one, originate transactions, and then two, execute on those transactions and see exactly how they'll be able to deliver on their performance objectives in the future. Real estate investors these days tend to be quite savvy, so if it means that they're prepared to wait, then I think they will do that, and we're seeing that in the data already. But I think we could see a second half weighted recovery in fundraising, but I think there are still some potential risks to that as we progress through the year. And I think a lot of people, myself included, I'm sure a lot of the listeners and participants in this session today will also be keeping an eye on these new COVID variants, and just to see how they are dealt with by the vaccines. So when we look at funds, a number of them are actually going to be beating their fundraising targets, but it is actually taking them longer to do that. So during Q2, 30% of those that are closed have spent more than 2 years on the road, compared to 20% of those that closed in 2020. So it's generally worth the additional time in market. Those 40% of those closed secured more than 100% of their initial target. However, again, this does point to investors being much more discerning in their allocations, with speed to market not a very important consideration at present. Manager selection, targeting the right strategy, seems to be much higher up the agenda for allocators at present. So looking at funds in market now, when we actually look at the drivers of growth of the funds in market, between 2019 and 2020, there was a more than 40% increase in the number of funds and less than 30% increase in the amount of capital that they were targeting, meaning that there was a much larger number of smaller funds. That said, the biggest funds, as we've seen, have had little trouble in closing, often above their targets, despite spending slightly longer on the road. And I think during the first half of 2021 particularly, there has been a solid increase in the number of funds in market. So between January and June, the number of funds increased by 14%, from 1,068 to 1,215. Yet, on average, the bulk of these new funds are generally smaller than those that preceded them, as the amount of capital targeted increased by only 8%. So each of these numbers is at record levels, but this is something that we've been saying actually, or a situation we've been describing for at least the last 4 years or so. And the question that begs is what makes this different to then? So with the number of funds closing and the aggregate capital raised falling significantly in 2020 and the pattern repeating so far this year, you could say that the increase in funds can be attributed to a weaker fund investor demand and a weaker fundraising market overall. This looks like it's creating a real overhang, with managers competing for allocations across strategies and across all fund sizes. So with this backdrop, it'd certainly be fair to say that competition for capital is incredibly fierce at the moment. And some of the things that we're hearing from our investor and manager clients is that specialism is one of the ways in which they can start to really differentiate themselves. So a fund can be targeted on a very, very particular part of the market, or they can be very focused on a very particular strategy. So whether it's value add and doing office refurbishments to reposition offices so that they're able to be attractive from a new way of working perspective, whether it's repositioning potentially retail assets as well, just to see whether values are declined to an extent that investors kind of get retail back on the radar again. That's another area where we're kind of hearing that some managers are trying to really differentiate and kind of push their long-term skills and make investors well aware of that. When we look at the funds in market grouped by size, what we can see here is that the market still remains dominated by those of $1 billion and above in size. So when we kind of drill down into the data, just 7% of those by number are seeking 39% of aggregate capital targeted. So that's unchanged compared to Q1. It might mean that these funds are actually going to take longer to hit their ambitious targets. When we expand that to $500 million plus as a fund size, the figures increase to 23% of funds seeking 67% of capital. So clearly, while the market is still evolving, some things are still remaining exactly the same. So another thing that Preqin likes to do quite frequently is compare the views of both our investors and our manager clients, so to see if they're consistent or if they're at odds with each other. Looking at this data, it seems that there is alignment on some things, but there's certainly disalignment on others. When we look at the results of this, we could question, are there too many real estate debt funds in market, given that debt's slipping out of favour among investors? We could ask whether the balance between value add and opportunistic funds is about right, and you could say that it probably is, based on what we see in front of us. We could also ask, will competition in these strategies mean some funds stay in the market for longer, or is there a good balance? I'd certainly say that managers with a good track record of delivery in the strategies that they're targeting will, certainly from what our investors are telling us, will be favoured over those who are new to a particular strategy. One question there as well is whether demand for core funds is being satisfied outside of the closed-ended vehicles, which are primarily those types of vehicles that are tracked by Preqin. And the answer to that is probably yes. What we hear is that and see is that many core type transactions, or many operators operating in the core space, they're doing this either going direct or through open-ended fund vehicles or through co-investments. And that's not always tracked in our data. So we probably do understate slightly the size of that part of the market. Excuse me. So when we're looking at our quarterly breakdown in real estate transactions, we can see that deal numbers in Q2 2021 are actually higher than the same period last year. So that was a period at which marked the low in deal activity during the pandemic across both numbers and aggregate values. So you could say we're higher, but we're cycling very, very weak comparatives. But one thing I would say is that while there's been a 6% increase in the number of deals compared to Q2 of last year, the increase in deal value is actually 32% higher. So we've got a much bigger increase in the deal value there. So during Q2, real estate transactions totaled $45 billion compared to $34 billion a year earlier. So this is pointing towards higher value transactions in terms of valuation and also larger transactions. But still, we have seen a significant decline since Q4 of last year. And I think we still need to be relatively cautious about what this will tell us for the rest of this year. And when we look at the composition of what deals are looking like, one of the things that we can see here is that portfolio deals are very much on the rise. So within our data, they're accounting for a rising proportion of our transaction data. We've seen a number of investors either look to divest from sectors where they've been particularly active in recent years. And we can really see that a lot of investors who are late to the party, particularly with regards to industrial assets, they're actually looking to gain significant exposure through portfolio transactions. One, it gives them exposure at scale in one fell swoop. Two, it gives them potential asset management opportunities. And three, it gives them an immediate income stream. So this is why these types of transactions are increasingly attractive. So within that, we can really see that industrial transactions, it does still remain probably the sector that's of most interest to our clients. Year-on-year industrial transaction numbers in Q2 are actually 3% higher compared to last year. So it'll be interesting to take a look later in the year to see which side of these transactions are going to be the winners. Will it be the buyers, particularly the portfolio deals, or will it be the sellers who've maybe been invested for an extended period of time? The hotel sector is another which has experienced year-on-year recovery and a quarter-on-quarter decline. So transactions in Q2 of 2021 doubled in the same period since the same period last year. There are still some big deals happening, such as the extended stay acquisition in the US, and investors, I think, are still looking to get on the front foot and ready themselves for the return of greater numbers of domestic and international tourists. Business travel, I think, is the big question mark, as it's unlikely that firms will resume travel to the extent to which we've seen in previous years, at least from the anecdotal evidence we've heard so far this year. I think one of the drivers behind that will be cost, and I think another of the drivers behind that is going to be, so one will be cost, and the other will just be a desire to really focus on ESG commitments as well. So in the interest of time, let me just plow through the retail deals here, so we can see retail numbers, deal numbers are significantly higher than they were at this point last year. We've seen a steady increase, and this begs the question as to whether investors now are actually taking a view that valuations have moved to a point at which assets are increasingly in demand, and they've repriced to make them quite attractive. I'll skip through the next slide, and I'm going to go on to my final slide here in the interest of time, because for those of you who saw our real estate global report, which was published in February, you'll have seen that we came up with a number of predictions for the year ahead. What we've done here is to try and look at exactly how our predictions are doing and see whether we're on track with those predictions, were we right or were we wrong. And I've graded ourselves here as a B minus. I think we've been right on some things, with, say, for example, competition for industrial assets, a recovery in hotels, but maybe we were wrong about retail, given the early signs of evidence that market's moving. There's certainly rising interest in emerging markets that hasn't necessarily translated through to actual activity on the ground yet. But I think we're tracking pretty well against our predictions thus far. So I think that draws my part of this presentation, or part of this session, to a close. So I want to take time to thank you very much for listening today. And if you have any questions, please do get in touch. We'll make these slides available to participants later. So thank you.
Dave, thank you very much. Excellent presentation.
My pleasure. Thanks very much indeed.